Property, or more specifically the ownership, trading and development of income-producing real estate such as offices, shops, warehouses, factories and data centres. And infrastructure, which includes all those things a modern society needs to flourish, like roads, railways, airports, power, communications and water. These are all businesses that are often monopolies and are in demand regardless of what the economy does. So in this episode, we're going to look at why these assets are essential to your portfolio as they are to the regular functioning of a modern society. I'm Vince Scully, and this is Investing. So real estate forms the first part of the BRICS component of growth assets, along with infrastructure, which we'll come back to later in the program. So real estate shares many of the characteristics of infrastructure, such as the backing by real assets and long-term stable inflation-linked rental income. And this is one of the three characteristics that define both of these asset classes. So real estate provides stable and predictable cash flows by providing a service that's essential to the tenant and has the benefit of steady, reliable revenue streams secured by long-term leases, usually to credit-worthy tenants. It's inflation protected because most leases include a provision to increase rents with inflation, and some in the retail space also include a portion of what's called turnover rent, which is an additional rent as a percentage of the sales made by the tenant. And the third aspect is diversification. So real estate investments typically have a very low correlation with traditional asset classes like equities and bonds. By way of example, DJRE, the real estate ETF that we'll talk about later, has a correlation of 0.66 with the Vanguard Global Equities Fund for the 10 years to December 2025. So adding real estate to a portfolio can enhance diversification, potentially increasing returns while reducing overall risk and volatility. And it provides resilience and downside mitigation. So long-term leases, mostly to creditworthy tenants, mean they tend to perform consistently through economic cycles, including recessions and periods of market volatility. This is generally true for small declines, but proved not to be true during the GFC, where the proximate cause of the market collapse was lack of liquidity in the securitization markets and hence in the property financing space. Putting that in context, the MSCI, the Morgan Stanley Capital Investors Global Equity Developed Market Index, was down 49% between December 2007 and March 2009, while this is a bit of a mouthful, so work with me here, guys. The FTSE, the Financial Times Stock Exchange, EPRA/NAREIT Developed Ex-Australia Rental Index, that's the main global property index, was down 36%. But for the decade between 2005 and 2015, both delivered similar overall returns. It also wasn't true in 2020 when the Vanguard Global Share Fund was down 23% for the period from the end of February to the end of March, while the property index was down 34%. And that property index is trading roughly where it was in February 2020 at the end of calendar 2025. Now, the office market still hasn't recovered from the shift to work from home trend, and retail remains subdued. Logistics, self-storage and data centres, though, provide some positive news. And of course, they have long-term return potential. Most buildings are built to last decades and can benefit from the intrinsic value of the underlying land. So all of these are great reasons to allocate some of your portfolio to real estate. And as I mentioned, real estate fits in the growth asset category and can in many ways be thought of as low beta equity backed by real assets. Now, by low beta, we mean beta is shorthand for the total market return. And so a low beta stock is one that moves around less than the market as a whole. So many investors ask whether if I have a home and maybe an investment property, do I need to allocate part of my portfolio to real estate? The short answer is yes, but how you get there is quite interesting. So starting with your home, first of all, owning your home represents a significant, illiquid, owner-occupied asset, while real estate investment trusts, how your portfolio would include real estate, are liquid, income-producing investments in professionally managed, diversified portfolios of diversified properties, such as offices, malls, industrial. And they serve a fundamentally different role in your portfolio. Think about your home as a hedge against rising rents. It represents security and also a store of wealth. Your investment property, although it may look a lot like your home, plays a different role still. Residential property, supported by generous tax incentives, a shortage supply, and ready access to low-priced debt, has helped generations of Australians build wealth. But residential property behaves differently, so both have a complementary role to play. Like most things in personal finance, it's not either or, but how much of each and when. So that leads us on to the question, well, how do I invest in real estate when it comes to my portfolio? And there are two main ways. The first, possibly the more traditional approach, was individual property syndicates. These are illiquid, often available to wholesale investors only, and suffer from many poor or under-resourced managers. And for the most part, at least for beginning investors, are best avoided. The alternative to the individual syndicate is the REIT, or Real Estate Investment Trust. Or better, a portfolio of REITs, or an ETF or managed fund portfolio of individual REITs. So starting with global real estate, like infrastructure managers, most real estate fund managers hedge the currency for the foreign exposure as they would tend to do with bonds. However, this is to fundamentally misunderstand the nature of real estate. I think it's better to look at it as low beta equity backed by real assets. So low beta shares move less than the market as a whole, but for the most part deliver equity-like returns. And as you generally wouldn't hedge your equity exposure, because the reason you choose to invest overseas is to get currency diversification in part, and therefore you shouldn't hedge your real estate exposure. Unfortunately, fund managers developed the habit formed when real estate was simpler, more bond-like and less highly geared, and it is now difficult to find an unhedged real estate ETF. The silver lining in all of this, of course, is that the list of Australian listed core rental developed market unhedged real estate ETFs is a very short one. In fact, there's just one, and that is DJRE, which is a State Street ETF which tracks a Dow Jones real estate index. So it's similar in size to the other two options, which I'll come back to in a moment. It manages $524 million. It's got a slightly higher MER, or expense ratio, than the other two at 0.2%, but a similar spread at 0.14%. And it had the lowest inflows over the last 12 months. It is ESG screened, which many investors question, but the biggest impact the ESG screening has here, which really focuses on the environmental performance of the building. It looks at the building itself and the owner of the building, not the tenant. And the biggest impact this ESG screening has is the exclusion of gaming properties. So the two big ones missing from the main index is Vici Properties Inc., which holds a number of casinos in the US, and Gaming and Leisure Properties Inc., which together make up about 2.5% of the broader index. But the fact that it's not currency hedged makes it our choice of exposure in this section. The alternatives adopt FTSE indexes. That's the Financial Times Stock Exchange from London. This one is a real mouthful, so follow me through on this one. The FTSE EPRA Nareit, which is effectively the national or the Association of Real Estate Trust Managers. They have a developed ex-Australia rental AUD hedged index, which are broadly similar to the unhedged ESG screened one that DJRE uses. In fact, there's a 95% overlap in their holdings. So these two represent the big ones. So REIT, great ticker, that's the VanEck FTSE International Property Hedged ETF, is the largest at 640 million and has the same management expense ratio as DJRE, but the highest spread at 0.17. GLPR is the lowest MER at 0.15% and the tightest spread at 0.13. This one gets the most inflows and has the highest monthly liquidity. But for the hedging question, this would be our choice. When it comes to Australian real estate, the Australian listed real estate sector is a completely different beast. So Australian REITs, mostly for historical reasons, tend to have more exposure to development, which is a completely different risk profile to holding property long-term to earn rental income. And it doesn't display the same defensive characteristics as rental property. So I think Stockland, Mirvac, Dexus. This index is also highly concentrated, with Goodman Group making up a third of the index. Historically, Westfield occupied that position, but it was taken over by Unibel some years ago. And Goodman, or GMG, as its ticker is, has done well, extraordinarily well recently from its high focus on data centres. There is a fairly high overlap with the ASX 300, the normal equities index, with 6.5% of the ASX 300 also in the S&P ASX 300 REIT index. VAP, the Vanguard Australian Property Securities Index ETF, is the OG here. It's got $3.2 billion under management, 2.5 times the combined assets of the other two players. SLF, the Spider S&P ASX 200 listed property ETF, tracks the S&P ASX 200 A-REIT index, is just under 540 million under management, a lower MER at 0.16, but a higher spread at 0.13%. MVA, the VanEck Australian Property ETF, is a more concentrated portfolio of just 13 REITs with a weighting cap of 10%. That is, it's got no more than 10% of the fund can be invested in any one REIT. It's got the highest MER at 0.35% and 853 million in assets, as well as attracting the bulk of new money over the past 12 months. And it's got a medium spread of 0.11%. It's also delivered the highest performance of the three over 1 and 10 years, but the worst over 3 and 5. VAP is our pick here, but a separate allocation to Australian real estate, we think, adds unnecessary complications unless you've got a very large portfolio. So having whizzed through real estate investing, we're going to take a break, and when we come back, we'll move on and look at infrastructure.
This Is Investing is brought to you by Life Sherpa Invest. If you want your money to work harder and not just sit in a savings account earning crumbs, check out Life Sherpa Invest. Choose from 4 risk-based portfolios like Everest 90 with 90% in growth assets. Long-term, low-cost and built for people who are after serious returns. Invest from $5K today at lifesherpainvest.com.au/invest and start climbing.
So Infrastructure 2 forms part of the BRICS component of growth assets. And it shares many of the characteristics of real estate, such as backing by real assets, long-term, stable, inflation-linked revenue streams, and, importantly, monopoly characteristics. But it also includes elements of business activities, which give it some more equity-like aspects. On this basis, we would expect it to be more resilient than real estate and be capable of higher returns. And certainly over recent times, that's proven to be the case. Now, There's a wide spread of views or thinking around what constitutes infrastructure, especially among fund manager marketing teams. And there's a growing trend of considering things like hospitals, childcare centres and prisons as social infrastructure. In many cases, these more closely resemble real estate, and we wouldn't consider them to be part of the infrastructure allocation. I like the FTSE Russell definition, who's the main provider of the index, and they use this definition in defining the universe for inclusion in that index. And they define core infrastructure activities as those involved in the development, ownership, operation, management and maintenance of structures or networks used for the processing or moving of goods, services, information, people, energy or necessities from one location to another. And they only include companies that make at least 65% of their revenue from one or more of those core activities. And in practice, this means transport infrastructure, so roads, bridges, tunnels, ports, airports, railways, and terminals and depots for storage of container depots, for example. And to a lesser extent, it includes inland waterways. Not a lot of that in Australia. It also includes the traditional utility space, that's electricity generation, distribution and transmission, water supply, gas supply and pipelines generally. And it also includes telecommunications, so the fixed line, telephone and data networks, the transmission lines and towers that support that, and the satellites that support that too. And that creates a universe of about 274 companies with a combined market capitalisation of $2.8 trillion US dollars, of which 133 of those companies and 2.6 trillion are in developed markets. So this is primarily a developed market sector. And what all these companies have in common are stable and predictable cash flows because they provide essential non-cyclical services that are always in demand regardless of economic conditions. This leads to steady, reliable income streams, often secured by long-term contracts or tight government regulation. They also tend to be inflation protected, so most infrastructure providers get to raise their prices in line with inflation through either regulated fees or contractual agreements that are explicitly linked to inflation. And anyone who's used a Sydney toll road will know precisely what that looks like when it hits your hip pocket. They're also quite diverse. So infrastructure investments typically have a low correlation with traditional asset classes like equities and bonds. So the Vanguard Infrastructure ETF, global ETF, which I'll come back to later, has a correlation of 0.57 with the Vanguard Global Equities Fund for the 5 years to December 2025. So this means that adding infrastructure to a portfolio can enhance diversification and potentially increase returns while reducing overall risk and volatility. They're also quite resilient and provide some downside mitigation. The essential nature and often monopolistic positions of infrastructure assets mean they tend to perform consistently through economic cycles, including recessions and periods of market volatility. This proved to be true to some extent in the GFC, where the MSCI World Equity Index was down 49% between December 2007 and March 2009, while the Global Core Index was down just 35%. But it wasn't true in 2020 during the pandemic, when the global equities market was down just 3% for the period from February to December 2020, while the infrastructure index was down 20%. The initial decline in that sort of March-April period, when we were just beginning to work out what all this stuff meant for us, was similar, with both down by 25% at the end of March and both recovering to being 15% down by the end of April. The global equities index recovered within 12 months, but the infrastructure index took another year beyond that to recover. And that's because the traditional resilience disappeared because we stayed home and didn't commute on toll roads, Airlines were grounded, airports were largely closed, and industrial output fell, reducing the demand for electricity. But they do have long-term return potential, so infrastructure projects are built to last for decades, and the asset class offers exposure to powerful long-term structural trends such as population growth, which drives sustained demand for upgrades and for new development. And all of these are great reasons to allocate some of your portfolio to infrastructure. But before we get into the meat of how you can include infrastructure in your portfolio, I've got a confession to make. So, investing in infrastructure is as old as the stock market itself. From the canal boom of the 1790s, before war with France burst that bubble, to the railway boom in the 1840s, which ended following a Bank of England rate hike in late 1845 that triggered capital calls that investors couldn't meet, leading to share price collapse, company failure, and ultimately to the commercial crisis of 1847. Even what is now the Dow Jones Industrial Average began in 1890 as an index that primarily tracked railroad stocks, which were the dominant form of transportation in the US economy at the time and the vast bulk of the stocks traded in the London Exchange. In Australia, Telstra was the country's largest company in 1998, 50% bigger than the number 2 company, National Australia Bank, which in turn was twice as big as the size of the CBA. In Canada, Nortel at its peak in 2000 represented 38% of the entire Toronto Stock Exchange. But the world changed in the 1990s as Macquarie Bank, little old Aussie bank, led the world in financing infrastructure with landmark projects such as the M2 motorway in Sydney and Transurban in Melbourne. As a founding member of that infrastructure team, one of my jobs was to convince fund managers to allocate more to the sector. In pitches, we likened it to real estate and pointed to the bond-like returns of these early projects. Our theory was to lead them to the unfamiliar via the familiar. The negative of this, which we didn't really appreciate at the time, was that it led most managers to currency hedge much of their foreign exposure, as you would tend to do with bonds. However, this is to fundamentally misunderstand the nature of infrastructure. It's better to think of it as low beta equity backed by real assets, much the same way as we think about real estate. And as you generally wouldn't hedge your equity exposure because the reason you chose to invest overseas was in part to get currency diversification, and so you shouldn't hedge your infrastructure exposure. Unfortunately, fund managers developed the habit, and it's now difficult to find an unhedged infrastructure ETF. And for this, I am deeply sorry. But back to the topic of today. The silver lining of this, though, is that the list of Australian-listed core developed market unhedged infrastructure ETFs is a very short one. In fact, there's just one, and that is the Vanguard Global Infrastructure Fund, or VBLD. Although it's much smaller and more expensive than the 2 hedged options, it is our pick. It manages $562 million, has a management expense ratio of 0.47% and a spread of just 0.10. But the lack of currency hedging and the use of a more representative index makes it our choice to gain exposure to this sector. The alternatives also adopt FTSE indexes, which in our view are the purest infrastructure index, but they use a different index. So GLIN, the iShares Core FTSE Global Infrastructure AUD Hedged ETF, has $1.4 billion under management, and IFRA, the VanEck FTSE Global Infrastructure Hedged ETF, with $1.7 billion, are the dominant players in this space. GLIN has the lowest MER at 0.15%, the highest liquidity, and the lowest spread at 0.09%. And it also attracts the most inflows over the past year. IFRA is slightly higher in management fees at 0.2% and has the highest spread of the 3 at 0.12%. Both IFRA and GLIN track the FTSE Developed Core Infrastructure 50/50 hedged into Australian dollars index. And that 50-50 is the important differentiator here because it places some artificial caps on the sectors within the index. So this index places a cap of 50% on utilities, 30% on transportation, and 20% on other. And to our view, these are both undesirable tilts. And therefore, we take the smaller VBLD as our preferred exposure. So both real estate and infrastructure have a vital role to play in your portfolio, delivering diversification, stability, and lowering volatility. Now, if you want to learn more about how we use these insights to construct our portfolios at Life Sherpa, head over to lifesherpa.com.au/invest. I'm Vince Scully, and this is Investing.
Thank you for listening to This is Investing. Any advice is general financial advice and does not consider your objectives, financial situation, or needs. You should consider whether the advice is appropriate for you before acting. Always read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs before buying any financial product. Vince Scully is a representative, and Simo Interactive, Pty Ltd, and Glenn James are authorised representatives of Money Sherpa Proprietary Limited, which holds Financial Services Licence 451289. And if you want further investing fun, the Quick Start Guide to Investing, as endorsed by Vince, obviously, is available wherever good books are sold, or there's a link in the show notes to get your copy today.